One of the more common requests or insights that I'm asked about is to do with the foreign exchange reports and their implications for the cross rates. I only write reports on the six majors. The main reason why I don't write daily reports on the cross rates is for a lot of the time they're not really doing a great deal. And for those of you who read the reports carefully, you can connect the major supports and resistances associated with the dollar rates in order to find that you might actually by default have a cross rate position anyway. However, I'm going to show an example whereby there's a little bit of a connection to fundamentals as well as some very strong technical signals that suggest that there could well be some a good trend develops in the Swiss franc against the Japanese yen. So this is the one that we're going to concentrate on today. First thing really is, as mentioned about a week ago, the dollar yen rate has decorrelated from the S&P. This has been a long-standing correlation whereby if the stock market was weak, the yen was perceived to be a safe haven, and so generally the dollar yen would fall. That completely broke down last week in the fact that the S&P finally broke the major distribution low at 807 and has trended down since then, but the dollar yen has actually been going up. One possible reason for this was there was some pretty grim news coming out of Japan last week, and there's a real threat of depression, which is where growth falls by more than 10% year on year. And this could be an element of changing sentiment in the yen as a safe haven. So with that background on the yen, looking at the dollar rates, the yen is actually weak, and the strongest currency at the moment, or what appears to be potentially the strongest, is the Swiss franc. And unusually for rates against the dollar, their distributions are actually opposite, in that the dollar yen rate has a very bottom heavy distribution and the dollar Swiss rate has a very top heavy distribution. This is highly unusual and suggests that there could be some major shifts in sentiment and the possibility of an extended trend in both the major rates, but more specifically in the cross rate. First of all, we're just going to look at the Swiss yen rate on a daily chart as it stands at present. We've been pretty much going in a sideways pattern since December. The lows were marked by three divergence patterns. The black squares are a KPO based divergence and is relatively rare. It's rare to see two signals so close together. And the pink arrow is the RSI divergence, as mentioned in chapter 4 of the book Trading Time. So the first signal failed, and then the second two signals worked reasonably well. Looking at the KPO, somewhat unusually, we managed to get a peak out in this sideways pattern back in towards the end of January, and that situation is now, that oversold situation is now unwound. Now we're looking at the dollar Swiss daily, and there's really three things that stand out here. The first thing is that when we had the previous fall back in December, the market became oversold. You can see that there's two red arrows on the chart above two candlesticks, and one was on Friday. What this is one of our more aggressive proprietary divergence signals, which is called a UFO. It's a relatively simple pattern. All it's saying is that price is making a 9-bar high and the RSI is making a 3-bar low. There is no value on the RSI, which means that occasionally you can get divergence as a continuation as well. This is a study that is used relatively sparingly, and it's called congestion count. And what this study does is look at the current bar in this particular setup and says how many of the previous bars has it been engulfing. And we had quite an unusual setup, in that once the congestion count goes above 15, it's a signal that we're now waiting for a breakout. So we've been going sideways, we're now waiting for a breakout, and we're going to go with whatever direction it happens to be. You see, back in December we had a very similar thing happen here, where we were above 15 and then we had a strong trend down. Now we move on to the market profiles of the two majors, and the first one we're looking at is the dollar yen. And this distribution is actually quite a long one, in that it dates back to September last year. And the thing that really stands out when we scroll through this distribution is its bottom heavy nature. So the control point is effectively at the bottom of the trend, and now we are very much above that level. What this means is that there is the potential for lots of short covering, as people have spent a lot of time or built positions that are on the wrong side. And so the support points really are pretty powerful at 91.18. Then we have 90.63 and obviously the control at 90.06. In terms of resistance, if we can get above this 94.70 distribution high, then we start trading into all of this, and there isn't a great deal that really stands out until possibly above par at 102 and then a major level up at 103.74. I've now moved on to the dollar Swiss, and this is really almost the exact opposite. The distribution is somewhat shorter and it began at the end of December, but if we look at the trend and scroll up, we can see that really it's the opposite, in that it's very, very top heavy. And on Friday, not only did we get that divergence and the reversal based on congestion count, we've now broken below the control point. There's really three key levels to look for. First of all is if we start trading below 114.80, it really does open up the possibility that we could move quickly down to 113 or so. And then if we could get below 111.60 and 111.06, there's really very little support after that point. In terms of our resistance, ideally what should happen is the market should fail at control, so 115.92 to around 116.10. It really has to then trade above the vacuum point created on Friday up at around 117.20 to say that actually the the dollar Swiss is no longer bearish. Now we move on to the Swiss yen rate itself, and from the point of view of how you build distributions, it's a little bit tricky because we really made a low back in December, but then we've gone sideways, and then a new trend really started in January. So for me, I'm taking that new trend in January as the driving force at the moment. And there's one key thing that happened back on the 17th of February, and that was the fact that the price held control of this short-term trend perfectly. And now we're starting to break up. If we look at the resistances that are set from that sideways trend, we really don't have a great deal until up here, and we have to look at the previous trend to see that there's like a mini distribution here. So if we start trading above 81.60, we could rapidly get up to here. So in conclusion, there was multiple divergence at the lows. The recent trend from January saw control hold this week. Resistance is light with only two major levels. Ideally, control needs to hold any correction back down. The key levels to watch, 81.60 above and then 83.60 to 84.12. If at any point we do break through this, then I'll do another update. And the key support is at 79.92, which is really the top of that mini distribution that it's trying to build. And the area down to control, which is at 78.55 to 01.